Hello and welcome. In this lecture video, I'll be talking about preferred stock and also doing some quick check problems associated with preferred stock, okay? So preferred stock is a separate class of stock. It's separate than common stock. And it's called preferred because the stockholders of preferred stock have a first right to dividends. So they have a preference on dividends before common stockholders, okay? So they get paid their dividends first before common stockholders. There's also, they have a preference on the distribution of assets in case there's a liquidation. So in case there's bankruptcy, liquidation, they have a preferred holding on the liquidation of those assets. Preferred stock also usually has a stated dividend rate. Okay, and we'll see that in some of the example problems. There's a stated dividend rate, usually does not have voting rights. Okay, and so it's not issued by all corporations. All corporations have common stock, but many corporations also have preferred stock. Okay, and when we talk about some reasons why a company might want to issue preferred stock, they might want to raise capital without sacrificing control. And that's because there's usually has no voting rights. And it can also to appeal to investors who believe the corporation's common stock is too risky or the return on the common stock is too low. And so then by purchasing the preferred stock, they have the preference on dividend distributions. They get paid dividends first before common stockholders. Okay. So what we're going to talk about now are the journal entries for issuing preferred stock, and then also talking about the dividend preference of preferred stock, okay? So we talk about the issuance of preferred stock. It's pretty similar to what we talked about issuing common stock. It's just recorded in its own capital account. So rather than in common stock, it's recorded in preferred stock. So for example, when Dylan Snowboards issued 50 shares, of $100 par value preferred stock for $6,000 in cash. Let's record the transaction. So we're going to debit cash for our $6,000, and then we will credit our equity account, preferred stock, $10 par value, which is the 50 times the 100. Remember, $100 par value is only done for teaching purposes. That's not real par values. Par values are much, much lower. Okay, I just want to make sure that, but sometimes it just makes it easier to teach. Okay, so we have our 5,000 right over there. And then just like what we did with our issuing common stock, the difference between the par value and then the market value, which is how much cash you get, goes to paid in capital. So it goes to paid in capital. And I'm just going to write paid in capital because I'm running out of room. But remember, the full account, it's an equity account. The full name of the account would be paid in capital in excess of par value, comma, preferred stock, not common stock. And because it's recorded, it's its own capital accounts. Okay, so that's that $1,000, which is the difference between the market value and then the par is the $1,000, and that's credited to the equity account, paid in capital in excess of par value, comma, preferred stock. Okay. We also have, let's talk about dividend preference of preferred stock. So preferred stockholders are going to get paid their dividends before common stockholders. Now, within the dividend preference, though, of our preferred stockholders, we have two different classes. We have a cumulative preferred stock, and we have non-cumulative preferred stock. Okay? So what cumulative preferred stock means is that those preferred stockholders who own cumulative preferred stock, they have a right to be paid with both current and then all prior periods unpaid dividends before any dividends are paid to common stockholders. So that means they get paid this year's dividends, and then if last year the corporation didn't pay dividends, they get last year's as well before the corporation pays common stockholders' dividends. Okay? So when that preferred stock is cumulative and then the directors did not declare a dividend in the prior period, that's called dividends in arrears. Okay? So let's talk about non-cumulative preferred stock. That means, unlike cumulative, there's no right to the prior period's unpaid dividends. But they still get paid this current period's dividends before common stockholders. They just don't get prior periods unpaid before common stockholders. Okay? So let's look at the difference right over here with our cumulative versus non-cumulative. Okay? So when we look at this example, it says, consider the following stockholders' equity section of the balance sheet. The board of directors did not declare or pay dividends in the prior year. But in the current year, the board declared and paid dividends of $42,000. Okay? So this shows us our statement of stockholders' equity right over here. We have common stock, $5 par value, 40,000 shares authorized, issued, and outstanding. Then we have our preferred stock. Now see this 9% right over here? Remember how I talked about the preferred stock often has a stated rate? This is the stated rate. This is our dividend rate. Okay? 9%, $100 par value, 1,000 shares authorized, issued, and outstanding. So total paid in capital. So when we said the board declared and paid dividends of $42,000 in the current year, let's look at that situation with reference to non-cumulative and then cumulative. So if the prior year was year 2010, there's nothing paid to preferred and nothing paid to common. And then in the current year, 2011, it says we're going to pay the $9,000. Now, how did I get $9,000 right over here? It's the 9% of the total par value. Okay? The total par value, the 100 times the 1,000 right over there, gives us the total par value times, so I take my 100 times my 1,000 times 0.09, which is my stated dividend rate. That gives me my 9,000 right there. So I'm declaring $42,000 total, so I have to go $9,000 to preferred based upon their stated dividend rate. Anything that's left over goes to common. Now, when we have cumulative, again, nothing was paid in the prior year, nothing in 2010, but what we have to do, because it's cumulative, we have to pay those preferred stockholders this year's $9,000 and last year's $9,000. So a total of $18,000 goes to preferred, and then we take the $42,000 minus the $18,000 that we paid to preferred, which is from last year and this year. That means only $24,000 is left over for common. Okay? So that's that difference between cumulative and non-cumulative. Cumulative, you get paid for prior years. Non-cumulative, only this year. Okay? So some additional points here on common stock. We can also talk about convertible preferreds. Additional points of preferred stock. Convertible preferred stock and then callable preferred stock. When we have convertible preferred stock, that gives the holders the option to exchange preferred shares for common stock at some specified rate. If that common stock increases in value, those convertible preferred stockholders can convert their preferred stock to common stock, and of course that makes preferred stock more attractive. Callable common stock, on the other hand, gives the corporation who's issuing the preferred stock, callable preferred stock, gives that issuing corporation the right to purchase that stock at specified future prices. Well, that makes the preferred stock riskier for a preferred stockholder, right? And so when that happens, the amount that the corporation has to call and then retire that preferred shares, the call price, and that's set, and normally that includes a premium. Normally includes a premium. So that's what I'm saying right over here. That issuing corporation is going to have to pay the call price plus those dividends in arrears when it calls and retires that stock, and it's going to be generally a premium because you have to compensate those preferred stockholders, because they're saying, well, you can call in my preferred stock and I want to be compensated for that risk. Okay? So what I want you to do now is pause the lecture video, and I want you to do this quick study problem on page 145, and then we'll go ahead and do the one on page 339, number 146 here on page 339. We'll do that one together, but I want you to do this one here, number 145 on page 338 by yourself, and then check your work, okay? Thanks. Okay, let's check your work. So I hope you got A as the right answer. So number 145 here, Extreme Sports, has 100,000 of 8% non-cumulative. So this is non-cumulative, which means that if they didn't pay anything in the prior year, they don't get paid for those. Okay, the preferred stockholders don't get paid for those before we pay our common. All right, preferred stock outstanding. They also have 500,000 common stock outstanding. No dividends were paid in the first year, which is the prior year. Now the second year, Extreme Sports says we're going to pay 30,000. Who gets what? So we take our 100,000. This is the total par value. This is my stated dividend rate times my 0.08 gives me $8,000 that goes to preferred. Then I subtract that from the 30,000. That means $22,000 is left over. That goes to common. A is the right answer. Okay. Now let's look at number 146. So it says right over here, the company has 1,000 shares of $50 par value, 4.5% cumulative. This is cumulative though. Okay. Preferred stock and 10,000 shares of $10 par value common stock outstanding. They paid $1,000 total cash dividends in the first year, okay, of their operation. So what we have to do is figure out what is the preferred stock dividend. And the way we do that is we take the total par value times the stated rate. Well, the total par value is equal to our 1,000 shares times that $50 per share, and then times our stated dividend rate, 0.045. Right there gives us $2,250. So I'll come over here and I'll say year one should have paid $2,250, right? But only paid $1,000. Which means $1,250 is in arrears. Okay, that's that dividends unpaid from the prior year. So there's $1,250 in unpaid dividends from the prior year, from year one. Now in year two, they come over here and they say, well, okay, how much are preferred going to get? Well, they get this $2,250, right, which is their stated dividend rate. 1,000 times the 1,000 shares of our preferred stock times the par value times the stated dividend rate. So they're going to get for $2,250 for year two, plus this $1,250 that they didn't get paid for year one. Okay, $3,500 is how much they're going to get paid. D is the right answer. Before, that will be how much they get paid in year two before any dividends are paid to common stockholders. So because this is cumulative, they get paid those dividends that they were owed for prior years, which is right over here. They were owed $1,250. They should have been paid $2,250. They are only paid $1,000. So the company owes them $1,250. Those preferred stockholders, because it's cumulative, get paid those prior year dividends plus the current year, which gives us the total of $3,500 before common stockholders get paid their dividends. And that's what we mean by preferred stock. Preferred preference in terms of dividends. Okay, and there's some other preference also in terms of liquidation, but for the context of the problems that we're doing here, preference in terms of dividends. And that's very important because that makes preferred stock more attractive because you get preference in terms of those dividends. Okay, so I'm going to end this lecture video now, and then the next and final lecture video will cover earnings per share. Thanks so much. Bye.